Welcome to today's Explainer. Okay, let's dive into this. Today, we're looking at a fundamentally crucial topic for all auditing professionals and students. We're talking about Standard on Auditing 200. This standard literally lays down the overall objectives of the independent auditor, and it explains exactly how an audit is conducted in accordance with the essays. Let's take this journey together to really understand the true essence of an audit.
Here's our auditor's blueprint for today. We'll be thoroughly covering 6 areas: scope and objectives, key definitions, premise and duties, core requirements, evidence and risk, and finally, limitations and compliance. We're going to cover everything you need to know, line by line.
Starting right off with Section 1, Scope and Overall Objectives. So the scope of SA 200 is very precise. It establishes the independent auditor's overall responsibilities when conducting an audit of financial statements in accordance with standards on auditing. Now, why do we actually do this? Well, the main purpose of an audit is to enhance the degree of confidence of the intended users in those financial statements. It's really all about building trust through a structured professional evaluation. What are your actual objectives as an auditor? First, you must obtain reasonable assurance that the financial statements as a whole are free from material misstatement, whether that's due to fraud or just a simple error. Doing this enables you to express an opinion on whether they're prepared according to the applicable financial reporting framework. Finally, you have to report on those financial statements and communicate your findings. Do note, if you cannot obtain reasonable assurance and a qualified opinion just isn't sufficient, you must strictly disclaim an opinion or withdraw from the engagement entirely.
Moving on to Section 2, key audit definitions. Grasping these is the absolute foundation of the entire framework.
Now, what's really interesting about this slide is how these core terms interact like a puzzle. The applicable financial reporting framework is basically the benchmark adopted by management. We examine historical financial information, which is just data about past economic events. We communicate with those charged with governance. These are the folks overseeing the strategic direction, like a board of directors. And we are always looking for a misstatement. That's simply a difference between what is reported and what the framework actually requires. Let's continue breaking down these definitions. Audit evidence is the information you use to base your opinion. Now, cleanly separate these next two in your mind. Sufficiency is the measure of the quantity of your audit evidence. Do you have enough of it? Appropriateness, on the other hand, is the measure of the quality. Is it relevant and reliable? You need both quantity and quality to achieve reasonable assurance. And remember, reasonable assurance is a high level of assurance, but it is never absolute. Let's jump to Section 3, the premise and responsibilities. We need to contrast these two sides very clearly because an audit is built on shared duties. Management is responsible for preparing the financial statements, designing internal controls, and providing the auditor with unrestricted access to information. In fact, in India, under the Companies Act 2013, the board of directors is explicitly responsible for laying down internal financial controls and preventing fraud. The auditor's responsibility, however, is strictly to form an opinion based on the essays, obtain reasonable assurance, and issue a report. The audit absolutely does not relieve management of their own fundamental responsibilities. Now, for Section 4, Core Auditor Requirements. This sets up the strict ethical standards you must follow. An auditor has to comply with relevant ethical requirements, primarily the ICAI Code of Ethics. You must uphold integrity, objectivity, professional competence, confidentiality, and professional behavior. But most importantly, you must maintain independence. That means independence of both mind and appearance. This is what safeguards your ability to form an unbiased opinion. In the Indian context, Section 141, subsection 3, and Section 144 of the Companies Act 2013 further govern auditor disqualifications and strictly prohibit certain non-audit services. This ensures independence is never compromised. Next, let's talk about the auditor's mindset. Professional skepticism. You must maintain a questioning mind and critically assess all audit evidence. Do not just accept documents blindly. If you see contradictions, you have to investigate them. So, the crucial point is this. Even if management has shown absolute honesty and integrity in past years, that past honesty does not relieve you of the need to maintain skepticism today. Always be alert. Alongside skepticism, you must exercise professional judgment. Listen, professional judgment isn't just guesswork. It's a highly trained competency applied to complex facts. You use it to make informed decisions on materiality, to determine the nature, timing, and extent of your audit procedures, and to evaluate management's own accounting estimates. And here's the kicker. These judgments must be well documented. The standard requires your documentation to be clear enough that an experienced auditor with no previous connection to the audit can understand exactly how you reached your conclusions. Section 5. Audit evidence and risk. Pay close attention as these concepts are tightly interconnected. So what exactly is audit risk? It's the risk that the auditor expresses an inappropriate audit opinion when the financial statements are materially misstated. Let me clarify something very important here. This technical term only relates to the process of auditing. It definitely does not include the auditor's own business risks, like adverse publicity or facing a lawsuit. It is strictly about your opinion on the financials. Audit risk is basically a function of three components. First, inherent risk. This is the susceptibility to misstatement before we even consider any controls at all. Think of highly complex calculations. Second is control risk. That's the risk that the entity's own internal controls will fail to prevent or detect those misstatements. Now, inherent and control risks belong entirely to the entity. The third component is detection risk, which is the risk that the auditor's own procedures fail to detect a material misstatement. That risk belongs to you, the auditor. And this brilliantly illustrates the inverse relationship we have to strike. If the auditor assesses the entity's inherent and control risks, which are collectively known as the risks of material misstatement, to be very high, then the acceptable detection risk must be kept very low. To achieve a low detection risk, you have to perform much more rigorous and persuasive audit procedures. You're balancing the scales to keep the overall audit risk at an acceptably low level. Finally, Section 6, Limitations and SA Compliance. Let's look at the boundaries. Complying with the standards is completely non-negotiable. You must comply with all SOAs relevant to the audit. You need to understand the entire text, not just the basic requirements, but the application and explanatory materials too. If, in highly exceptional cases, you absolutely must depart from a specific requirement, you are mandated to perform alternative procedures to achieve the exact same aim. Most importantly, you cannot represent compliance in your audit report unless you have fully complied with literally all relevant SOAs. So why can't an auditor just reduce audit risk to zero? Well, because of the inherent limitations of an audit. The nature of financial reporting inherently involves subjective management judgments. The nature of audit procedures is also limited. Management might intentionally conceal fraud, and auditors don't have official legal police or search powers. We also have to balance reliability against timeliness and cost. Finally, there are specific challenging areas, like related party transactions and senior management fraud. And speaking of fraud, remember that under Section 143, subsection 12 of the Companies Act 2013, auditors in India have a specific statutory duty to report frauds directly to the central government. Let's move to and see how this builds our final conclusion. Can an audit guarantee absolute perfection? The answer is a very clear no. Because of inherent limitations, audit evidence is persuasive rather than conclusive. But it does guarantee reasonable assurance. While an audit isn't a magic absolute guarantee, it remains a highly reliable, structurally sound mechanism. So, the next time you rely on an audited financial report, ask yourself, are you looking at a guarantee of absolute perfection or the result of a rigorous, reasonable assurance process? Like, share, subscribe for content like this.